So let's look at some decisions that may come up in a managerial situation. The first one being is special order pricing. This happens when customers call you and say, hey, I would like to buy your product, but I want a special pricing order because of X, Y, and Z. And managers have to go through this and figure out, is it worth it? So this occurs when companies get an order from a customer requesting for a special price that is less than the normal sales price. At times, the price requests may appear to be less than the total product cost. So it may actually look like it's going to present a loss to your company. But the further we dive into it, the more we realize it still could be a positive. It actually still could be a gain if we do it this way. How do we do that? Well, common reasons why a company would accept a special order pricing request. Well, sometimes for products that are made to customer specs, that would be one situation. For unusual orders, perhaps. For one-time jobs, to utilize production facilities. Maybe they have this extra production facilities and they have the ability to create more. So they're going to use it for special order pricings. Now, what are some qualitative issues that should be considered when it comes to special order pricings and whether to say yes, you accept it or no, you don't? Well, first and foremost, what precedent does this special order set for future jobs? If you take on the special order pricing job, is it going to have a negative effect on future orders? Are they going to expect the same thing over and over and over again? Are you setting that precedent? Another one is, how will regular customers react? Are they going to be mad that they got to have to pay a higher price than the special order? Is there enough production capabilities to produce the order without reducing normal production? This is a big one because obviously if we're going to do special order pricing and we have to produce more, we're not going to take away what we're already doing at regular price. So we need to be mindful of that as well. Let's look at an example of this one. So assume a company produces a premium widget. One widget typically sells for $30 and a new customer contacts the company to offer to purchase 5,000 widgets at $25 each. So we normally sell them at $30, but they're offering to purchase 5,000 right now for $25 each. Each widget has the following product cost. So based on annual production of 20,000 widgets, the direct material is $8 per unit, direct labor is $5 per unit, variable overhead is $6 per unit, and fixed overhead is $7 per unit. The question to you is, should the company accept the offer? Well, let's look at this at a first glance kind of thing. At first glance, if we add up all of our costs, we have direct material of $8 per unit. We have direct labor of $5 per unit. We have variable overhead of $6 per unit, and we have fixed overhead of $7 per unit. We add that up, that gives us a total cost of $26 per unit. And if they're offering to sell it or buy it for $25, our unit sales price would be $25 per unit. According to this, our cost per unit is going to be $26. Therefore, it's going to yield us a unit contribution margin of $1 unit, and that's a loss. So obviously, based on this, we wouldn't take it. However, let's dive a little deeper in this. We don't want that. So let's dive a little deeper and see what information is actually relevant. What's avoidable and what's unavoidable. So a deeper look would say, okay, direct material, I would obviously have to have direct material. Again, we don't care about the fixed overhead side, but direct material would still be $8. Direct labor is going to be $5. Variable overhead is still going to be $6. But because it's fixed, it doesn't matter if I produce these 5,000 or I sell these 5,000 or I don't sell these 5,000. The fixed cost is fixed. It's not going to change. So we can take that out. That's an unavoidable cost. It's an irrelevant cost. So we can take that out and not even put that in the equation. So in reality, our actual cost for the product is going to be $19 per unit, not $26 per unit. So if we put that into our calculations, our unit sales price that they're offering is $25. Our unit variable cost is going to be $19 per unit. Therefore, this is going to give us a unit contribution margin of $6 per unit. And that's a gain. So if we do sell these 5,000 widgets, that's going to give us an increase of $30,000 in our net income because that's going to be our contribution margin. So this would be a no-brainer in this situation, assuming we have the capacity to do this. That's an example of special order pricing.